Welcome to Peachtree Point of View with Greg Friedman, the podcast that shares insights and strategies to navigate dislocated markets and capitalize on mispriced risk.
I'm Greg Friedman, CEO of Peachtree, and this is another episode of Peachtree Point of View. So today we're fortunate to have Bennett Webster, who I've known. Bennett, I feel like I've known you forever. It's got to be like 20 years. We've had multiple calls at 3 a.m., 4 a.m. before I'm going to the gym, and just really picking your brain on different markets as it relates to hotel assets. And today we're going to talk about, really what's happening across the hotel space. There's a lot of interesting things happening in commercial real estate, a lot of challenges, but a lot of opportunities with what's happening with interest rates being higher for longer, to inflation, what's impacting the performance of hotels. To get your thoughts today. Maybe just start out quickly, give your background and so forth.
Yeah, I appreciate it. I like the commentary on the early morning phone calls. I feel like in a lot of change in the world, but so few things are as consistent as Greg Friedman answering the phone call at 5 a.m. So good to be able to rely on that, if nothing else these days.
Right.
Yeah, Bennett Webster, principal and founder, Alchemy Real Estate Advisors. We are a brokerage advisory firm. Launched just a little under a year ago, and just thought and sought to capitalize on what we think is a pretty fractured landscape in the hotel brokerage advisory space. Our real secret sauce here is just sort of taking a blue collar work ethic, sleeves rolled up sort of mindset to our engagements while being institutionally minded at the same time, and leveraging I think a lot of the tech and AI and the tools that are at our disposal to just drive pricing and hopefully better serve our clients. We are just under a year into the new shop. We've had 21 closings to date, including some trade activity with our good friends over at Peachtree, and we've got another 19 under contract and contracts out on a whole bunch more. Fortunately, been very busy amidst some broader dislocation in the market these days.
Yeah. So the market today feels, as you mentioned, just so heavily dislocated. Right? There's just a lot happening across the hotel space. From your perspective, where do you see the most opportunities? Is it buying debt positions? Is it really just owners that are under pressure due to maturing loans? Or are you seeing something else in the market?
Yeah, I think distress can take any number of different forms. In the past couple of months, we've sold NPLs in Midtown Manhattan. We're working through a receiver sale in downtown Seattle. Working on a big box REO trade in Houston. It can take all manner of different sort of sizes and shapes these days. I think there's no shortage of ample opportunity out there. There is distress by way of sort of traditional distress for receiver REO NPLs. And then we're working with plenty of folks that frankly are just late life cycle on their investment, and they may still be in control of the sales process, but rest assured we're looking at some pretty mandated and not forced sales, but sales that I think a lot of our friends on the ownership side would prefer to be a little longer on, and just for whatever reason capital markets may have caught up. Brand mandates may have caught up, and selling some positions that may no longer be accretive to the portfolio.
From a standpoint of just the transaction market, I feel like there's a bifurcation. When you look across all of commercial real estate, we've seen this bifurcation in the market where certain assets appear to be trading a lot easier than other assets as it relates to the hotel space. I mean, is there any trends where you're seeing, even with all this dislocation, are you seeing pockets where certain types of assets are probably getting pricing that's probably,
getting more activity? Sure.
Yeah, exactly.
Yeah, I think JLL, our friends over at Jones Lang, put some notes out a week or two back. Roughly 50% of the trade volume on the first half of the year has been 50 million or under, and they don't bifurcate that figure any further down. But I suspect if they did sort of subsets of 40, 30, 25, 20, the majority of those trades would be 25 million and under. That market remains highly liquid, remains highly fluid. We're seeing tremendous price integrity from our vantage point. Still selling a lot of assets at negative leverage. Maybe it's some regional folks that believe they can step in on a well-located Home2 Suites in Lexington, Kentucky, or a couple assets that we're selling in Indiana right now, and feel that they can sort of squeeze that extra juice out of those singles and doubles rather than take a larger position on a bigger full serve deal. I think the yield is going to be there on those more select serve plays. I think anyone seeking any sort of additional alpha or more opportunistic returns are starting to look more aggressively at some of these markets that have been more heavily fragmented, where there continues to be dislocation. I've seen more bullish activity, more bullish sentiment on San Fran, for example, in the past couple of weeks than we have in the past couple of years. I think there's certain other markets that are going to continue to lag behind a little bit further, the Portlands and maybe some of the Chicagos, Minneapolis to a lesser degree, but still plenty of folks that are willing to take swings at those.
That's interesting. San Francisco, just hearing San Francisco is getting more interest because, I do think San Francisco long-term recovers. It's been more of a duration risk story, at least from our perspective. And then you have like a market like Portland, Seattle, was a little bit slow to recover. Obviously, you talk about San Francisco, really all Silicon Valley was slower to recover, but it feels like those markets are starting to all sort of pick back up at some level. Are you seeing like just inbound activity where groups are targeting those markets, or are you seeing more assets just hit the market? Like for instance, in San Francisco?
I think we are seeing sellers at a point getting increasingly comfortable where they think that there's a parting of the clouds and an ability to trade and maintain some price integrity. For several years, there was lots of chum in that water, and buyers were happy to swim in it, and sellers that had to sell were very much price takers. I think we anticipate more pricing integrity, specifically in some of those, I'd say, late to recover, but more fundamentally sound NorCal markets, Seattle. I think Portland's got a little bit of a longer road there, and we're starting to see some increased distress in that market with some of our friends in the CMBS space. You just run the traps on TREP and you look at what's out there, and there's going to be more coming in Portland specifically.
Yeah, and what's, just out of curiosity, comparing, because you've been through so many cycles now as it relates to hotel assets, are you seeing any differential trends this time around, like on transactions, how things are transacting today compared to, say, during the pandemic, pre-pandemic, as well as going back to the GFC and so forth? Has there been any changes or anything unique this cycle?
I think what we're seeing now is in part cyclical. I think it's in part structural, and we're at the tail end, what we consider to be tail end of essentially a 5-year recovery year post-COVID. But the RevPAR trajectory has slowed materially, and consequently expenses have remained high. We just saw some updated commentary from CoStar this past week. I think they were essentially flat for RevPAR growth for the back half of the year. And yet I didn't see the CPI read today. I saw the markets rebounded, so it had to have been favorable. But most recent CPI, we were mid-twos. And if we have flat RevPAR growth and flat revenue growth and expenses still continuing to outpace that to the tune of 200 bips, we see a tremendous amount of yield dilution. So I think there's a lot of buyers out there that are obviously needing to put money to work and eager to put money to work. This is what they do. They do deals. They want to do deals. I think they're just a little more cautious in underwriting tremendous residual upside. This is not 2023 where we saw year-over-year RevPAR growth of 500 bips. Last year, we were up 180. This year, I think we're going to be flat to about 100 bips. I think buyers are a little more cautious, albeit still active. I think sellers are now, after a couple of years of extend and pretend and sort of currying favor with the brands on renovation lifecycle stuff and PIP lifecycle stuff, are now at a point where they're saying, okay, we got to cycle this money out. Maybe our LPs are asking us to funnel some of this money out. Maybe the franchise is saying that we're going to ask you guys to renovate, or we're going to have to talk about the future of the flag with that particular deal. So it's kind of an interesting time. I'd say waters are definitely a little bit choppy, but it's the market remains very transactable.
Yeah, it's sort of interesting because like extend and pretend, like when you look at the wall of debt maturities, it's just continued to grow because of the extend. And you go back 2 years ago, you call it on a forward 12-month basis, going back 2.5 years ago or so, on a forward 12-month basis, you had call it roughly $450 billion of commercial real estate loans maturing. Fast forward today on a forward 12 months, you're facing close to $1 trillion loans maturing. That's not all hotel loans, obviously. It's across commercial real estate, but it's just growing at this unprecedented level that's not really sustainable. And it's seeing a lot of fatigue across lenders, which should bode well for your business, just because I think that's going to create, more of a catalyst, causing ownership groups to be forced to sell as banks, because, about 50% of this debt's held regional banks, community banks, the national banks that just, they have regulatory pressure that can disincentivize them from continuing to extend at some level. So
Yeah.
I think there's a day of reckoning coming is my point, but it should be something that's very constructive. Have you seen anything from the standpoint of just as groups are trying to sell assets? Because it feels like the biggest reason assets aren't trading is that, the view of a seller, they view the asset value obviously much higher than where the buyer is. And, intrinsic values have reset down probably more than where they're the market. So is there anything, are people doing anything to sort of bridge that gap with like earnouts, or have you seen that being a bigger piece, having earnouts or a structured sell or seller financing or anything unique?
We would love to approach the vast majority of our deals with some sort of creative seller carry, some ability to juice the leverage in a way in which is mutually beneficial. I think the unfortunate reality for a lot of our friends, at least on the ownership side that are selling right now, they are selling as a means of returning capital to LPs. They are selling as a an intent to monetize and to not be long on these assets. And if there is a situation where there is the ability to sort of sell or carry, it's oftentimes tough to get a meeting of the minds in terms of who's owed what and what that promote structure may look like over a longer term trajectory. I think the situations where we've had tremendous success has been particularly on the CMBS side, getting CMBS loans assumed and getting clever and creative in terms of how we structure that. And, we've been able on multiple occasions now to get some additional life out of those existing loans, maybe get clever with a little bit of IO for a ramp and stabilization period. And in those particular situations, we've been able to find a means of driving pricing for selling well above where market debt rate may have afforded a purchase price to be. And conversely, the buyers benefit from having that certitude on what is otherwise a unobtainable but highly attractive sort of bridge loan type situation. And buyers still at this point have to take on the ancillary risk of getting to cash neutral refi in 12, 24, 36 months. But in the interim, they're stepping in a pretty lucrative cash on cash yield that I think will, sweeten the prospects of doing that particular deal in the current market.
What type of advice would you give today, just someone that's looking to invest in hotel assets as you look over the next 12 months? Like, where would you tell them to sort of focus their attention to find the best value, just knowing how dislocated, how challenging the environment is to transact, and how challenging the environment's been for even sellers to sell at pricing that's in a lot of cases for buyers. Where would you tell a potential buyer to focus for the next 12 months?
You see where some of our friends on sort of the upper end of that institutional spectrum are playing, the Blackstones, the hosts, the Trinities, seeking out these sort of irreplaceable upper upscale luxury assets that are really tough to replicate in normal times, let alone when we're in the current capital market situation that we are, where shovels in the ground are tough to get that new construction financing. We really like the optics on that luxury segment right now. Our friends at Host were on Squawk Box this past week and commenting on just the price elasticity and the underlying strength of their consumer, both relative to just, where they've been able to push ADRs, but also just higher cost amenities like F&B and golf and spa treatments and all those things that sort of further pad the bottom line. But obviously it's only a handful of folks that are out there stroking 9-figure checks right now. So I'd say for the typical sort of PE shop and portfolio owner operator, to me right now, diversity is the name of the game. Looking for those markets where you have scale operationally and ownership wise and that sort of thing. Looking for those markets where maybe you have quasi arm's length or friendly lenders that can help you get to a favorable capital stack and probably taking a few more shots on goal than you otherwise would. And I think there's plenty of opportunities out there for that. And to me, this is sort of the time where that Blackstone mantra rings truest. And it's the notion that capital structure is temporary, but purchase price is permanent. And if you're long on this hotel game and you don't plan on going anywhere, and if you got the stomach for it and you got the operational capacity, I think it's a wonderful time to be out there buying and maybe get a little creative right now. Maybe debt's a little more expensive than you otherwise would have wanted it, but there will be opportunities on a forward-looking basis to refi into lower cost of capital and more attractive leverage.
Yeah, I couldn't agree more. I mean, I think this is a very, in one breath, it's a very challenging market to operate in. clearly it's a challenging market to operate in, as we talked about, or you really talked about and said it very well, just with, expenses really outpacing, revenue growth right now within lodging. I think that's going to be, hopefully more of a shorter term issue, just given the lack of new supply that's getting built. So, when you look across the whole sector, but that is a challenge. But then it's a very hard environment to go operate and going out transacting and buying assets today. I think you're completely correct. You're very creative and you're decisive at the right time, very patient in this market. You can find some really these where long term they're going to be, great assets. Just given how dislocated the capital markets are, and unfortunately the impact of just having a higher for longer interest rate environment, invest significant capital back into these assets, especially so many of them are derived from having PIPs over the last several years. Because I think PIP expenses are really, groups that have completed PIPs or renovation plans since the beginning of the pandemic is down dramatically. I think it's down. There's a lot of for maintenance needed. I'm assuming you're seeing some of that driving sales as well.
Yeah, absolutely. I mean, several of our institutional clients right now, they are selling out of these positions where the brand is saying, we're looking for you guys to do some renovations now. And if not, we want to know what your plan for monetizing this position is. So we can get some fresh legs in there that are going to recycle that product. I think there's additional pressure on that too, just with the fact that new construction financing is less abundant than anyone would like right now. That puts additional emphasis and onus on the existing owners to take that Hampton to a Spark, to take that Fairfield to a City Express, to take that legacy sort of late 90s vintage residence and squeeze another 10, 15 years out of it. And again, because there's shortage of new construction financing, and in theory that should get some additional longevity out of those existing assets. It just unfortunately comes at a heavier renovation ticket than I think most people are expecting or frankly want to see right now.
And Bennett, I really appreciate you joining today. We're out of time, but it definitely, I think you really highlight very well that this is an environment that, have a very creative mindset to go, find transactions to buy. You got to have a very patient mindset, but also be very decisive, be willing to really go out there and aggressively look around the market, because there's a lot of opportunities, but there's a lot of challenges. There's a lot of deals that don't make sense, but there's a lot of acquisitions that do make a lot of sense in this environment. You got to be able to pull together the capital stack to make it sense. So you got to have the right, capital partner, like lender on board with you in order to be successful and have that sustainable success at that asset level. But if you're able to execute, I think we've seen so many times in these moments of dislocation, you find your best, investment opportunities. Very bullish on the direction of the business, but really want to say thank you for joining us, and I always love working with you. You've obviously helped us sell assets, buy assets in the past, and really appreciate the partnership and really appreciate everything you do for us as well. So thank you for joining us today.
Thank you, man. I just want to return the compliment, and I'll just say, out of all of our friends in this space and clients, I'm hard pressed to think of another example where the growth has been as sort of inspiring as we've seen with you guys. And I was joking with the guys earlier today that I think this Greg Friedman black hoodie getup is your Steve Jobs black turtleneck. So we're holding you guys in the highest of regards, and been super, super inspiring to watch that growth. And so thank you for lending us your lengthy coattails here to continue to ride along on. It's been awesome, man. Thank you.
Yeah, anytime. And again, really appreciate it. So thank you. And this is closing of another episode of Peachtree Point of View podcast. Thank you.
Awesome. Thank you.
That's it for this episode of Peachtree Point of View. If you found value in the conversation, hit subscribe and share it with your network. For more insights, visit us at peachtreegroup.com. And until next time, keep crushing it.